Hello, dear students of M.Com Sem 1 of this university. Very good morning to all of you. I am Dr. D.K.Mitra from P.G. Department of Commerce and Business Management, Kolan University, Chaivasa. Today's subject of discussion, the subject is financial management, and the topic of discussion today will be the financial decisions. As you know, dear students, that several financial decisions have to be taken by a business concern, and there are before landing on to the different financial decisions, let me tell you that, as you know, all of you know, that there are basically two schools of thoughts regarding the objectives of financial management. There are two objectives, two schools of thoughts. That is, one is the profit maximization, and another is the wealth maximization of the shareholders. Now, in pursuit of, see, the wealth maximization approach being the objective of financial management, it is the modern school of thought. That's why we will be considering the wealth maximization objective of financial management, and this objective has to be taken into consideration while discussing the different financial decisions. There are several financial decisions which have to be taken by a firm in pursuit of the wealth maximization of the shareholders. Those decisions may be, say, investment decisions, financing decisions, and dividend decisions. Let us discuss one by one each and every financial decisions, important financial decision. Number one is the investment decision. See, dear students, investment decision is the most important financial decision that a firm has to take. It is the most important decision. Do you know why this is so important? Why this is very important financial decision? Why it is considered as a important financial decision? There are two reasons behind this. One is because the cost is involved, and another is the availability is limited. So basically, there are two reasons of it. One is the cost is involved. Whenever you are taking any investment decision, the cost is involved. You must understand what cost is involved in each and every investment, wherever in whichever project you are going to invest. And another is the fund availability is very limited. These are the two basic reasons for which we can say that investment decisions are very, very important. Now, investment decisions relates to what? That we have to understand. Investment decisions relates to what? There may be three things to which this investment decision is related to. That is the total amount of assets. What will be the total amount of assets? What will be the composition of assets? And what business risk is involved? These are the three things regarding the investment decisions. What is going to be your total amount of assets? Fixed, current, or whatever. What total assets you are going to have? Number two, what is your composition of assets, and what are the risks involved, business risks involved. Now, let us classify the investment decisions first, so that we can have a better idea of the investment decisions. Investment decisions are classified basically into two categories. One is the long-term investment decisions, and another is the short-term investment decisions. Let us first of all discuss the long-term investment decisions. See, the long-term investment decisions, all of you know that it is called capital budgeting. Now, investment decision in capital, well, in capital budgeting, what does it mean? It is an investment decision in capital expenditure. That is the fixed assets. Now, what is capital expenditure? Capital expenditure is the expenditure the benefits of which are spreaded over a long period of time. You cannot consume the benefit of the capital expenditure within 1 year. The benefit the benefit is to be consumed it is spreaded over several years. So the capital expenditure means the expenditure, the benefit of which is spreaded over a long period of time. What is that long period of time? Long period of time means exceeding 1 year. Now, dear students, there are two things that we have to understand regarding the long-term investment decisions. The investment proposals must be evaluated in terms of expected profitability. Always the investment proposals there are several investment proposals. You have to evaluate in terms of the profitability. Number two, you have to consider the costs involved, and number three, that is what are the risks involved. This is what we understand by this long-term investment decision. The investment proposals must be evaluated in terms of three things: profitability, costs involved, and the risks associated with. Another important thing regarding this capital budgeting or long-term investment decision, dear students, long-term investment decision is taken not only for setting up new units. Long-term investment decision is generally, students understand that for establishing the new units, only the capital expenditure has to be incurred, long-term investment decision has to be taken. No, it is not only regarding the establishment of the new units, but also for the expansion of the present units, expansion of the present units, replacement of permanent assets, and research and development projects. So these are also very important. So the long-term investment decision is taken not only for setting up new units, but also for the expansion of present units, replacement of the existing units, and the research and development project also. So this is what we understand by the long-term investment decisions. Let us come to the short-term investment decision, dear students. Short-term investment decisions means you are taking decision of working capital management. Now, working capital management relates to allocation of funds among cash and cash equivalents, receivables, and inventories. Okay, the working capital management, whenever you are taking a decision, it relates to allocation of funds among cash equivalents, receivables, and inventories. Now, There are again two things regarding this working capital decisions or working capital or the short-term investment decisions. Such decisions, you know, it's a trade-off. Trade-off between what? Trade-off between liquidity and profitability. The more liquid the asset is, the less it is likely to yield. The more liquid the asset is, the less it is likely to yield, and more profitable an asset is, the less liquid it is. Another important thing is uh, which short-term investment decision you will be taking as the sound short-term investment decision. A sound short-term investment decision is one which ensures profitability and higher profitability instead higher profitability and proper liquidity. There must be a balance between the profitability and liquidity. The balance has to be ensured. This is another important thing regarding the short-term investment decision. So this is regarding the investment decision, dear students. Let us come to the second financial decision, that is financing decisions. Now, financing decisions involve two things. How best to finance, this is number one. How best to finance. And number two is searching for best overall financial mix. Such sources of funds should be selected which will make optimum way that it helps in maximizing the profitability of the concern. Such sources of funds should be selected which make optimum, you can say optimum capital structure. Now when we say the optimum capital structure means the debt equity ratio be fixed. The debt equity ratio should be fixed in such a way that it helps in minimizing the profitability, in maximizing the profitability of the concern. The debt equity ratio should be fixed in such a way that it helps in maximizing the profitability of the concern. The raising of more funds involve fixed liability. The raising of more funds in the form of debt, the raising of funds in the form of debts involves fixed liability, that you understand. On the other hand, raising of funds through equity will bring permanent earnings. The raising of funds will bring permanent earnings. Therefore, the financial manager has to strike a balance between various sources of fund so that the overall profitability of the concern improves. So the important task of the financial manager, dear students, is to strike a balance between the between various sources of funds so that the overall profitability of the concern is undertaken or it improves. So the financing decisions means you are considering the what will be your capital structure, the debt, the equity, The debt involves the fixed liability, raising of funds through equity means you are raising a permanent capital, but you are raising a permanent capital definitely, but the shareholders expectation is very high whenever, because expectation is high regarding what? Expectation is high regarding the rate of earnings. So the financial manager has to strike a balance between various sources so that the overall profitability of the concern improves. This is regarding, dear students, financing decisions. Now let us come to the dividend decisions. Whenever we are taking a dividend decision is concerned with the what this dividend decision means, dear students. The dividend decisions is concerned with the quantum of profits to be distributed among the shareholders. A decision has to be taken whether all profits in business are to be distributed, or the entire profit has to be retained in the business for the business purpose, or part of the profit is distributed among the shareholders and part of the profit is retained in the business, and part of the profit is distributed among the shareholders. So three things. Number one, whether you are distributing the entire profit among the shareholders or you are retaining the entire profit for the business purpose, or you want to keep a profit in the business and distribute a part of profit among the shareholders. Part of profit is retained in the business for business purpose and part of the profit is distributed among the shareholders. The higher rate of dividend, dear student, may raise the market price of the shares, and thus it maximizes the wealth of the shareholders. These are the three important decisions, dear students. The investment decisions. In investment decisions, you have seen both the things: capital budgeting and the working capital management. Number second, that is financing decision. The debt equity balance has to be maintained for a greater profitability of the business. And another, the distribution of the dividend decisions. Regarding dividend decisions also, you have seen three things. Whether regarding dividend decisions, it has to be seen in a way that what will be the quantum of profits that you are going to distribute it among the shareholders. Whether you want to keep the entire whether you want to distribute the whole profit among the shareholder, whole quantum of profit, or you want to distribute part of the profit among the shareholders, and part of the profit you want to retain in the business, or you want to retain the entire profit in the business. So different things are there in the dividend decisions. So but whenever there is a high rate of dividend, generally it signifies that the market price of the shares is very high, and when the market price of the share is high, it means that we are considering the wealth maximization of the shareholders. It maximizes the wealth of the shareholders. So these are the three important decisions, dear students, and it's a very important part, and you should prepare this very nicely you prepare this properly, this important financial decisions. Okay. Thank you, dear students. I hope you must have been benefited by my lecture on this topic. If you have any question, yeah, you can post your question regarding finance, any question on financial management or on the lecture that I have delivered to you. Whenever you are having any question, don't hesitate to post it to my WhatsApp number. My WhatsApp number is 7488 78315. 7488 78315. Thank you, dear students. I hope you are at home. You be at home and be safe. Thank you, dear students.